Thank you for joining us for today's Knowledge Labs webinar. My name is Jillian Mulvale. I'm the Associate Dean, Graduate Studies and Research at DeGroote, and it is my pleasure to welcome our audience, as well as our distinguished keynote speaker. Before the introduction, I'd first like to start with McMaster's land acknowledgement. McMaster University recognizes and acknowledges that it is located on the traditional territories of the Mississauga and Haudenosaunee nations, and within the lands protected by the Dish with One Spoon Wampum Agreement. We are always thrilled to see people joining these webinars from all over North America and the world. So thank you for your interest and continuing to support DeGroote and our programming. We're pleased to welcome Dr. Charles Lee as our guest speaker today and the Dr. Harry Lyman Hooker Distinguished Visiting Professor. A little background on this speaker initiative that McMaster has had the privilege to host. Dr. Harry Lyman Hooker grew up in Hamilton and graduated in 1904 from the Columbia University College of Physicians and Surgeons in New York City, and then went on to practice internal medicine. Upon his death in 1979, McMaster received a $25 million bequest, which supports numerous initiatives across campus. This includes the annual awarding of the Hooker Distinguished University Professor, which supports visits from distinguished speakers and lecturers. This award is an example of the lasting impact of a gift in a will, and McMaster's continued placement as one of the world's top universities is a testament to this generosity and leadership. Dr. Lee joins us today from Stanford University, where he is a Moghadam Family Professor of Management and Moghadam Family Professor of Management and Professor of Accounting at the Graduate School of Business. His area of academic interest includes studying the effect of human cognitive constraints on market participants and other factors that impact the efficiency with which market prices incorporate information. He has published extensively in leading academic journals on topics that include behavioral finance, market microstructure, quantitative investing, and security market regulation. Welcome, Dr. Charles M.C. Lee. Thank you for being here today and sharing your insights. But before we get started, there's just a few things we want to go over. First, there will be a Q&A period at the end of the discussion. Please use the Q&A function included in this webinar today to post your questions, and we will get to as many as we can. We have also collected the pre-submitted questions, and we will just try to answer as many of those as we can. Also note that this event is being recorded for marketing and promotional purposes to be shared within DeGroote, McMaster, or with our speakers, participants, and other partners. Please contact the marketing and community engagement team at DeGroote if you have any questions. With that, let's get to today's presentation.
Thank you very much, Jillian. It's great to be here. My only regret is I can't physically be at your beautiful campus. I just want to note that we are on this topic of Chinese equities. We are really in a very fast-moving period in which things and news events are occurring almost by the minute. And so it's really a timely topic, and I'm very excited to share it with you, opportunities and challenges in Chinese equities. You may have noticed that there has been Chinese equity news about a company called Didi, with the hail riding the Uber of China. And recently, the news has not been good. It's just gone down 20% because they're being asked, they're planning to go home. And this is only 5 months after they were listed on the New York Stock Exchange. And in fact, this morning, actually, I think it was yesterday, there is an article on Asian markets that says it's game over for US listed Chinese companies because the prediction is that Chinese companies listed on Wall Street, of which there are over 200, are likely going to be all going home. And yet, with all these difficulties affecting Chinese stocks, there are some investors who see this as an opportunity. Recently, Ray Dalio, who is the head of Bridgewater, one of the largest hedge funds in the world, raised $1.3 billion for a private fund in China. And it's not just Ray Dalio in Bridgewater. The BlackRock, which is the largest hedge fund manager in the world, was recently named as the first foreign-owned mutual fund in China. So they are making a push into China. JP Morgan, Goldman Sachs, virtually the who's who of Wall Street have said this is a great opportunity, once in a generation type opportunity to invest in this, in Chinese equities. Goldman Sachs, in fact, recently said that although investing in China is more challenging now, the country is not uninvestable. So what I'm going to do today is kind of try to put all of these recent events in a bit of a context. So I'll begin by giving you a historical context in which to think about Chinese equities and highlight some very important institutional differences between the Chinese stock market and the stock markets we're more used to over here in North America. I want to talk a little bit about the opportunities, what is attractive about today's opportunities in China, and a little bit about the challenges. In fact, I probably spend more time on the challenges because there are myriad. And then finally, I want to wrap up and talk about how to invest, or conversely, once you've heard all this, how to avoid investing in Chinese equities today. Okay, so let's begin with some historical context. Oh, yes, a little bit about myself. You've already heard some things about me, a couple other things that are relevant to this particular presentation. I was born in Taiwan. I say I'm MIT because I'm made in Taiwan. And I grew up in Canada, Waterloo and Cornell. And then I attended undergrad at Waterloo and graduate studies at Cornell. My teaching interests are very much in this area of quantitative investing and fundamental analysis and behavioral finance. I teach class on these topics. And in particular, I spent some time in industry in which I managed or was involved in asset management at BlackRock. Well, it used to be called Barclays Global Investors. And in 2012, I co-founded a company that invests in China, emerging markets and Asian markets. And very recently, just in this interest of full disclosure, Nipun Capital, we closed our China fund and we are redeploying capital into an emerging market small cap fund, just to foreshadow a little bit about my views about the current situation. All right, so let me talk about the Chinese equities, a little bit of historical context. You know, the modern China reform probably began with Deng Xiaoping, who in 1984 published or authored a very famous article on building socialism with specific Chinese characteristics. This is after the Cultural Revolution in China, and it was very much viewed, this market approach as viewed as an experiment. The idea is we're going to prototype a capitalism that does not yield control, that is essentially a market-assisted but central planning. In other words, we are still a central planned economy, but we want the market to help us. And as part of that, in 1990, the two stock exchanges, the Shanghai Stock Exchange and the Shenzhen Stock Exchange began trading. When you think about that, it's not very long. It's only been 20 years that the Chinese market, 21 years that the Chinese Stock Exchange even existed. And we know that in these times, there has been phenomenal economic growth in China. When you look at China's GDP and real GDP growth between 1978 and 2011, it is nothing short of miraculous. When the GDP grew from less than 150 billion in 78 to 9.2 trillion in 2013. That's an average GDP growth of over 10% a year for over 30 years. We've never seen this before in human history. And it lifted more than 600 million people out of the poverty level. So it is economically a phenomenal achievement. And today, China, the capitalism that we see in China is distinctly Chinese. There are many features here that are unique, even by Asian standards. You could call it a socialist market economy. So what does that mean? Well, it just means that the public sector, the state ownership and control is still there, but it is more and more a private economy that's driving the Chinese growth. And the stocks that are being traded on these two stock exchanges have many unique Chinese characteristics. So many of the basic rules of the road in China are not what we're used to seeing as investors in the West. For example, red is good. That's a nod, I think, to the communist association with red. So red is up, and a bad day in China is when everything's green. So, and it's not only the color, it's even something as simple as market capitalization, which is how big is the market total dollar value or total value of the publicly listed company. It's right now probably, this is a little earlier, but right now it's probably north of 12 trillion US dollars, most of which is in China, some of which is in Hong Kong, and some of it is in North America. But the market cap itself is not straightforward to calculate for Chinese companies. Why is that? Well, because when you look at the typical China Shenzhen Stock Exchange or Shanghai Stock Exchange A share, these are the shares that are publicly traded in China. Most of these companies have a float, a sort of freely tradable shares that are only a fraction of the total. Most of these companies, most of the shares are actually being closely held. That is, they're being controlled by a relatively small number of people. This is not by accident. Here is a average ownership of controlling block, the biggest control. So how much does the controlling block holder hold of Chinese shares? Well, SOE means a state-owned enterprise, and non-SOE is a private company. And you can see that the controlling block holder has, even as recently as 2014, still holds 40% of the state-owned companies. The controlling shareholder holds in 2014 only 33 or a third of the non-SOE companies. This is so what we have here is these are a lot of companies who typically have a block holder. So this is different from the US, where much of the holding, or in Canada, where the ownership is typically very dispersed across many shareholders. And the other feature about Chinese companies is that the number of state-owned enterprises, even as recently as 2014, is still a substantial part of the public companies. The non-SOEs has increased from 300 or so to 1,600, but the majority of the market capitalization, because the state-owned enterprises are bigger, are still state-owned. And China, in fact, has the largest state sector, that is the public sector, as a percentage of GDP in the world. The state-owned enterprises control 145% of GDP of their assets is 145% of the state GDP, and they are 26% of the revenue. And unfortunately, the state-owned enterprises, the companies that are owned and controlled by the state, have much lower returns. Their performances are not nearly as good as the private enterprises. And over time, the more and more the Chinese private companies are the ones that are driving the economic growth in China. And as of by 2018, 87% of the public employment is being provided by private companies. Exports, 88% are by private. And so most of the employment is coming from the private sector in China. But the difference between the Chinese private sector and ours is that state control is a very real part of their day-to-day operations. You don't get anything done in China without essentially getting the permits and requirements that are really still under state control. So all the companies, private or private or state-owned, face significant regulatory risk or policy risk. Okay, so let me summarize some of the key institutional differences that affect investing in China. The first is the legal system. In the US and in Canada, on the right, we're used to thinking of the court as an independent branch of the government, and judges have significant autonomy. And class action suits are common, and investors have legal recourse through civil and criminal proceedings when there is a grievance. But in China, the appointments of judges are by government officials and Chinese Communist Party committees. And court decisions are subject to adjudicative reviews by the same people. And so the investor protection actually falls on the CSRC, which is the equivalent of the SEC. It's the regulatory board overseeing public markets. And the lower courts typically don't use case law. They basically wait for a top-down judgment. So many times when there are grievances, the minority shareholder has no claim or no real recourse against the company. So this is a significant concern if you actually own a small part of a Chinese company. There's one other difference that's pretty important. The state-owned enterprises, the management of state-owned enterprises are appointed by the local Communist Party apparatus or some equivalent of that. And most of the CEOs then in the state-owned enterprises are ex-bureaucrats with career plans within the state firm system. Some person who's running a state-owned enterprise today could tomorrow become the mayor of a city or the head of a province. So you can see that incentive alignment may be a bit of a problem because we're pretty much used to having the CEO, incentivized by being a shareholder. But the career concerns of the top management in Chinese state-owned enterprises may be very different from what we see in the US. So there's a legal system difference. There are differences in managerial appointment and incentives. And also, whereas we are used to having many small shareholders, there is always a blockholder in a Chinese company. Okay, so these are some of the historical differences between the two economies. Let me talk a little bit about the opportunity set right now in Chinese equities. Back in 2014, Nippon Capital decided to start a China fund. So what's so attractive about China? And also, in particular, what is so attractive about China today? Okay, well, first of all, let's state the obvious. China is big. In terms of GDP, China is second to the United States. In terms of market depth of the public equity markets, China is also second to the United States. In fact, at the current trajectory, China is expected to overtake the United States in both in the next few decades. Yeah. So China is big. China is deep. The number of firms that by market cap in China orders in the thousands, and many of them are quite significant in size. And that makes them very attractive as potential investments. And the other thing which we found interesting at our fund is that Chinese traders tend to trade a lot. So one measure of that is what we call velocity, which is how frequently does a trader sort of turn over their position. Now, we've graphed it for Hong Kong, Shanghai, and Shenzhen. The average holding period for Shenzhen A-share stock is 25 days. So people hold their stocks for less than a month. In Shanghai, it's 50 days. In Hong Kong, it's 245 days. In the US, it's well over a year. Okay, so really what you have is a lot of people, a lot of retail investors who trade a lot. And that's actually useful if you actually are a systemic investor who actually, try to trade on fundamental values. Because the person on the other side of the trade is likely to be a retail investor or a speculator. Okay, and China also has some important structural advantages for investors. China has, in the past, up to 2015, invested very heavily in infrastructure. So today, for example, just looking at their high-speed rail system, China has 36,000 kilometers of it. Compared, if you can look down, the US is at 735 kilometers. In fact, China's high-speed rail system dwarfs the sum of the next 10 countries together. So there's been a lot of investment in capital infrastructure, which really positions you for growth once because these capital investments have already taken place. Furthermore, even China's been growing, and in recent times, China's growth is really changing. The sector of the economy pre-2015, that the sectors that have driven China growth has been largely in capital assets, investments. But since 2011, the industry and construction spendings have declined and service industries have gone up. In fact, now services industries have actually well overtaken industry and construction. And this is, so really the growth, not only the growth is fast, but the type of growth is really shifting towards much more of what we think of as a knowledge base or an emerging or a developing economy. China has also, until recently, been easing up on restrictions in foreign investment and participation. They're making shares more available for shorting. Shorting is basically the opportunity to essentially bet against a stock. Historically, China has not allowed that, but that's a problem because you have no way of allowing bad news to get into the price. But now more and more stocks are shortable. And that was very important to us because we both long and short stocks. And so we have a hedged strategy. And so that's attractive. You also see that China has continued to reform their stock markets. They are trying to turn something that used to be called a gambling casino into a real market. They are enforcing more insider trading laws. So insiders are actually being punished for trading. That's new. They're reviewing corporate governance, and they are actually, they for quite a while targeted getting included in the emerging market indices. For many years, China was not part of the MSCI and FTSE and S&P emerging market index. Today, they are at 35% of that index. So a lot of these things are encouraging if you are interested in China. Even more than these other things, today in particular, Chinese stocks are heavily discounted. As of today, if you look at the last year, the S&P has gone up 27% in the last 12 months. And this is as of this morning. But the Golden Dragon Index, which is a weighted average of the largest Chinese stocks, lost 41% in the same time period. So you see a very big divergence in performance And this has led to a dislocation in valuation. So on the basis of cash flows, the Chinese stocks look really cheap right now. In fact, here's an example. So Alibaba is probably the sort of the Amazon, if you will, of China. And as of yesterday, Alibaba's shares, the ADR shares traded in the US stock exchange is $126 a share. If I use the discount rate for Amazon, that is the cost of capital or what the market is currently using to discount Amazon's cash flows, but I apply it to Alibaba, Alibaba's stock price or Alibaba's present value of its foreseeable cash flows will be $249. In other words, if Alibaba the cash flows are being discounted at the same discount rate as Amazon's, Alibaba will be worth twice as much as it is now. So, and for this reason, a lot of Wall Street firms today are saying that China's stock market is likely to have a very big rally in the coming year. JP Morgan predicts Chinese stocks will rise by almost 40% next year. Okay, so that's our situation, okay, in terms of positives. But the list of challenges and risks that today's investors would face going into Chinese equities is actually pretty impressive. So let me talk about these challenges. First of all, we already talked about the fact that Chinese investors minority investors, that would be you and I, would you and me, are poorly protected under Chinese law. There is this problem called majority shareholder tunneling. What does tunneling mean? It means that the majority shareholder is kind of digging a tunnel underneath the safe and sucking out the money. That's where the term comes from. It refers to the exploitation or expropriation of minority shareholders by the controlling shareholder. So it's the transfer, in academic speak, it's the transfer of economic resources out of the company for the benefit of those who control it. Now, this is a concern all over the world. In most countries, public firms typically have controlling shareholders, and tunneling refers to how controlling shareholders kind of dig a tunnel under the company and siphon out the funds. And when you're a controlling shareholder, you can do this in many ways. For example, you can do advantageous transfer pricing to related parties. So the brother-in-law of the CEO, or not CEO, or the majority shareholder is the main supplier to the public company. So the cost of the input is much higher than the market rates. And then all of a sudden, the listed company is not profitable because the profit has been siphoned out to a related party. That's one example, but there's so many other ways in which a controlling shareholder can take advantage of minority shareholders. So that's a concern, which is typically quite difficult to identify and measure, but is quite extensive. And why is it particularly a problem in China? Well, first of all, as I mentioned, Chinese listed companies all have controlling shareholders. Okay, so that is second. Controlling shareholders can't always fully benefit from value appreciation of the stocks. Historically, the controlling shareholders are not at liberty to just sell their holdings. That has changed somewhat under reform in 2006, but even now, many block holders are not allowed to surrender control because control is a key building block of the state-controlled, if you will, private economy in China. So if they can't benefit from price going up, they figure out other ways to benefit as controlling shareholders. And regulators have a hard time monitoring them. And so this is still a potentially big problem in China. Now, back in 2010, we wrote a paper, my co-authors and I wrote a paper talking about the extensive nature of tunneling in China. This is a quote from the abstract. This study investigates a particularly brazen form of corporate abuse in which controlling shareholders use intercorporate loans to siphon out billions of renminbi from hundreds of Chinese listed companies for a substantial period of time. The particular abuse we describe has now been outlawed, but the incentives to do this continue. So it's just more subtle today. And that continues to be a risk for people who invest in Chinese companies. Okay, so that's bad enough. But if you're an outside company, if you're an overseas Chinese investor, you have additional risks. One of them is through something called a variable interest entity. So when Chinese stocks are listed overseas, for example, so here's what we mean by a VIE. This is the Chinese company is in the lower right. That domestic company is operating in China. But the company, for example, Alibaba or JD or one of the other companies that you can invest in North America, but that company is not what you're buying when you buy Alibaba shares. You're actually buying a share. You're the foreign investor in the upper right. You provide capital and technology and so forth, but you're really invested in a Cayman Island entity, typically the Cayman Island. And the connection is through a complex nexus of contracts. So you don't actually own the Chinese company called Alibaba. You own a Cayman Island company that has some contract agreements to transfer its profits to the Cayman company eventually. Why all this complication? Well, it was designed actually so that we can circumvent Chinese laws which prohibit foreign control of domestic companies. So, for example, Alibaba is really, as far as the Chinese government is concerned, controlled by Jack Ma and his management team. It's for their benefit. And so, particularly in sensitive industries like tech and telecom and education, financial and so forth. And so, why is that a problem for North American investors? Well, technically, VIEs are illegal under Chinese law. They were designed to circumvent foreign investment laws, but strictly speaking, these contracts are not legal and therefore not enforceable. Now, that has not been challenged hasn't even been questioned until very recently. The second, if you're a VIE, you don't actually own the company's assets. You own a cash flow generated by these companies. And that could be a problem. For example, Yahoo used to own 43% of Alibaba VIE, but the Chinese and Alibaba VIE owned the financial arm called Ant Group Financials. Now, Ant Group was extremely profitable and growing quickly. And the Chinese regulators said, oh, well, you're a bank and you're not allowed to be controlled by Alibaba. And so they had to spin it off. And shareholders of Yahoo, who used to have a 43% control of Ant, received a settlement that was much lower than what Ant eventually was going to be worth. But under Chinese law, the Yahoo had very little legal recourse. So this is an example of the type of risk, regulatory risk, that overseas investors potentially face under Chinese law. Now, there are a lot of popular Chinese stocks listed overseas, e-commerce stocks like Alibaba, Tencent, Baidu, DJ, Pinduoduo, and others, and many others that are involved in fintech, solar power, education, electric vehicles, and others. And every one of them that I've listed up here has a VIE structure. So in fact, there is substantial risk to foreign capital if rules change in China. Okay, so we've seen three pretty big problems already there is a fourth. We are now facing delisting risk that does not even come from the VIE entity structure. China has recently cracked down on tech companies over data security and IP issues. Didi, but not only Didi, Alibaba, Tencent, they're all under review. And Didi has agreed to go back to China. The others, people don't know what is going to happen. So you could get delisting even without the VIE structure falling apart. There are other problems. There are very few things in US politics in which we can get bipartisan support these days. We are an incredibly polarized nation over here. But one thing everybody agreed on was probably China. And in 2020, the Congress passed a bill in which the SEC required Chinese firms' auditors to be audited by a group called the PCAOB. China and Hong Kong are the only two foreign listing countries that does not allow the US PCAOB to review their auditors' working papers. That could potentially lead to delisting pressure from the US. And the US is also blacklisting a number of Chinese firms. This morning, actually, the US has announced that a drone maker is being blacklisted for participating in surveillance of Muslim minorities in China. There are a number of biotech firms that are on that list. We don't actually quite know why. But so what happens to investors if the stock is delisted? If an overseas listed Chinese company delists, the foreign investors presumably will likely receive equivalent shares in the overseas listing. For example, Didi is going to be listed in Hong Kong. So presumably, if you held Didi shares, you could actually convert them into Hong Kong equivalents. However, not all foreign investors can or would wish to hold these shares in the foreign exchange. And so there will be selling and there will be downward price pressure on these stocks as foreign investors exit. And the financial well-being of the foreign capital holder is frankly not a high priority to Chinese regulators. When Evergrande is in trouble, Evergrande's been in the news recently. What the Chinese regulators tell them to do is make sure that the workers are paid. They didn't say too much about the bondholders. Okay, so lots of risks, lots of delisting risks. One more, and I haven't even talked about it, which is the trouble in the dollar bond market. Chinese bond issuers of US dollar bonds are in trouble. And we've heard of Evergrande who is in official default, but Kaisa Group is also in official default. And yesterday, Shimao, which is a high-end property management company, also announced that they could be in delinquent in terms of their interest payments. So if there's a virus coming from China, there is one that is in the debt market right now that we are not sure how far it will spread. Okay, well, golly, after all that, let me wrap up. So I didn't recommend one thing or the other, although I did mention that Nippon is no longer in China. So let me talk about how you as a North American investor can today, if you're interested, invest in Chinese equities, or even conversely, having heard this talk, how you can avoid investing in Chinese equities. So first of all, where are these equities being traded? Well, as of a few months ago, most of them are being traded in the Chinese mainland stock market or on Hong Kong. These stocks you can access through an ETF, an exchange-traded fund that invests in them, or through a mutual fund that invests in them, or through a hedge fund. Or if you have an international brokerage account, both Canadians and US investors can trade, for example, through interactive brokers. You can directly trade in Hong Kong, and you can, through Hong Kong, trade some of the mainland exchange stocks. But you could also, there's another about 250 stocks that are in US and in the Toronto Stock Exchange where you can directly access these companies. The probably easiest way to invest in Chinese companies is to trade an exchange-traded fund. They are baskets of securities. So by buying a single exchange-traded fund, you hold a whole basket of Chinese companies. And here are some examples. On the Toronto Stock Exchange, you can buy something called XCH, ZCH, VEE, or a CHNA-B. Each of them basically invest in Chinese companies. In the US, there are many, many others. There are hundreds of them. Well, not hundreds, I guess there will be many dozens of them that invest not only in China, but in specific industry sectors in China. And even if you don't directly invest in China, it's useful for you to know that you're probably, or your pension money is probably invested in China. That's because the three major index providers, MSCI, FTSE, and S&P, all changed their global index compositions to include China. That happened between 2017 to 2020. And so if you hold any, if you're a pension fund or if you hold any global or emerging market index, the China weight right now in these indices is about 34%. Over a third of the emerging market is China. So what if you don't like that? It turns out that you could actually swap those types of stocks for those indices for indices that exclude China explicitly. For example, emerging market exchange traded funds that exclude China, they hold the whole emerging market, but they don't include China. There are also emerging market ETFs that do hold China, but suppose you don't like state-owned enterprises. I don't like state-owned enterprises. You can actually invest in XSOE, which is emerging market without state-owned. Or if you want China, but you don't want state-owned China, you just want the private companies, you can invest in CXSE. So there are ways in which you can actually specifically increase your exposure to China or specifically decrease your exposure to China. Okay, so let me summarize. Chinese equities are currently on a discount by historical standards, but these stocks are facing historically high levels of risk. And three risks in particular are worrisome: the weak investor protection laws, the increased geopolitical belligerence between the countries, and turmoil from a very heavily levered real estate market, which potentially could get much worse. Without providing specific investment advice, I would say there are good reasons why the Chinese stocks are currently on discount. Okay, I'll stop there.
Thank you so much, Charles, for that excellent presentation. Really appreciate it. I'd like to move us now into our question and answer portion of the talk today. And we have a couple of questions from the audience, but at this point, I would invite others if they would like to use the question and answer function to do so now. And maybe we can start with the first one that we received partway through your talk. So I'm not sure if it's specific to a particular portion from Cecilia that says, what is the impact of China developing a crypto blockchain currency? I don't know.
Okay, thank you, Cecilia, for that question. That's an excellent question. China is developing a cryptocurrency. You may know that China outlawed all crypto mining activities and ownership of cryptos recently, only a few months ago. Some say in anticipation of that development. I think that I don't know if it's the actual development of the crypto that will do this, but China has been hoping to dislodge the US dollar as a numeraire for international global trading. It's not clear yet whether or not they will be successful with or without the cryptocurrency. I think the main thing driving the renminbi right now is the fact that China has become more and more economically important, and that's just going to continue. Renminbi is extremely strong right now, historically strong against the global basket, and that's without a crypto. So I think that trend may continue whether or not China develops a cryptocurrency. Okay.
Okay, great. This is an anonymous question, but asking, why invest in China when there is a lot of external pressure against China from different foreign countries? Would it be better to wait for a bottom, which one would expect would come?
Yeah, that's a good question. The problem with bottoms is you don't know until they're gone. That's the worry. But I agree with you about the why invest now. Frankly, I don't know how to calibrate the risk because in China, the most important thing to keep in mind when you invest in China is that policies can change, and policy priorities are. You're not a high priority on the policymakers' radar screen. If you're a foreign investor, you are definitely not at the top of their protection list. So, for example, in the case of Evergrande and the real estate property developers, what they've done is they've issued US dollar bonds, and these foreign investors have invested because the yields are high. And now that these bonds are potentially in default, these companies are in default, there are economic fallouts for the Chinese economy. There are projects that are in the middle of being developed, real estate, that are stopped, and that can affect people's livelihood and jobs and stability in China. And that's the part that the Chinese government is most concerned about. You getting paid back as a bondholder, just, if they have to give, push comes to shove, that's just not up there. Okay.
So the next question from Mike, any specific insight about Chinese electric vehicle companies?
Okay, well, the technology, there are some very interesting companies there, and a number of them are publicly traded. Xpeng and NIO all have interesting models coming out, but Tesla is doing great business there, and they are actually locally producing cars. So I think that all of this electrical vehicle startups are at this point really speculative, whether they're Chinese or not. So I would not say that the Chinese car makers currently have an advantage over some of the startups here, and also some of the electric vehicles that are being produced by American car makers that are getting a lot of attention. Ford is one of the leaders there.
Okay, thanks. So Kimberly's commenting what an excellent presentation it was, and to thank you for that. The question is, how would you contrast European potential against Chinese and US? Is Europe the best place to bet our money?
I would say that you should get exposure to Europe because it's part of the global portfolio. In terms of diversification, there should be some weight placed to it. European markets are largely developed, as opposed to emerging markets, which most of which are in Asia. So I do think you should have exposure to it. In terms of valuation, they look cheaper, but how much to put into them? I'd say, just market weight, or it would not be a bad idea. I don't know that they're exceptionally better at this moment relative to their historical. They are a little cheaper, but their growth rates are not as high either. So.
Okay, our next one, again, congratulating you on an excellent presentation. saying, I was blissfully ignorant of the Chinese markets. So profoundly useful information, both for personal investing and understanding a major block of the world economy. I don't think there's a real question there, just more some feedback for you.
Great.
And then Eric asks, do you expect a wave of withdrawals of Chinese listed companies from the US market in the next year? Thank you.
Yeah, good question, Eric. A lot of withdrawals have already taken place. That's the reason why we see this huge drop in Chinese stock prices publicly listed. There's a very good chance that if the delistings continue, that there will be further drops, at least in the short run, at least over the next year or so. And there is a lot of pressure, both from the US and from Chinese side, to have a number of these sort of iconic names go back. So I don't know. I was really taken aback. I was really surprised at how heavy-handed the regulators have been in dealing with the tech names that are foreign listed. We've always known that could happen, but the fact that it happened so quickly and so dramatically and so, you know, so with so little regard to the welfare of the investors, that was eye-opening, and that started with Ant Financial, and then it continued with DD, but it is not stopping there. It really has impacted many Chinese companies. But to be fair, there were also casualties on the other side. So for example, Huawei was a superstar company, right? But the American embargo on parts for Huawei and the tough stance against Huawei has pushed Huawei to the brink of bankruptcy. So right now, Huawei is having many problems. And that's not because of Chinese regulations. In some sense, the Chinese regulation may be a retaliation for what happened with the American hardline against Chinese companies.
Okay, then we have a comment from Satyam. It may be possible to invest through American companies that have operations or subsidiaries in China, like Apple, General Motors.
Oh yes, that is an excellent comment. It was almost not, you're not consciously investing, but you could see like Tesla and Apple, their fortunes are really intertwined with the Chinese economy. So that is a very good point. Of course, those companies also have to play by the regulatory rules of China, which are somewhat capricious.
Right. Okay, another interesting point from Dwayne. Can you speak to the risk or reward for Canadian or US domiciled companies with most or all of their business in China, such as Canadian Solar, Tenet FinTech?
Yes, Canadian Solar is a company I've been watching for a while. They look so cheap, but they just keep getting cheaper. So, and yeah, so this is exactly a worry. I think that I'm most worried actually about the debt market in China, because China has far more debt than it looks. The public, you know, when we measure debt in the US as a part of GDP, we tend to just focus on government debt, which is now about 1-to-1 or slightly over 1-to-1 on GDP. In China, most of the debt is actually not the public government debt. It's debts sitting on, you know, state-owned enterprise books, corporation books, which are largely bank debts, and then the banks that borrow also from and there is a big shadow market full of debt in China that are shadow lending market that are not on the books. So in fact, almost all, a very large proportion of those debts are collateralized by real estate. So sort of any sign of weakness in real estate is potentially very worrisome. So yeah, I'm more worried about that at this point.
Okay. Another, thanks for a great seminar. Setting aside ADRs, what are your views on investing in China shares through the Hong Kong exchange instead? It would appear that delisting risk there is significantly lower.
Yeah, so that's a really good point. And in fact, Nippon was trading, the company that I mentioned was trading entirely out of the Hong Kong Connect program, which is traded out of Hong Kong. So yeah, there would be no delisting risk. There will still be a number of other risks, but in particular, the risk from a weak protection of investors. But what we were doing is we were long and short. So we were not having a necessarily a long net exposure on China. We were basically just picking stocks. So that made it less so. And I agree. Actually, I think that if Didi and others go back to China, they will actually get a lower valuation, for example, in Hong Kong, and that may be make them more attractive. So in terms of access, I think access through Hong Kong or Hong Kong Connect, if you have a ability to trade, perhaps through Interactive Broker, that would be probably less risky. So eliminate some risks, but not all the risks.
Okay, I think the next question is very similar. So just given the time, I think I'm going to switch to a couple of pre-submitted questions just to make sure we give them fair game as well.
Yes.
First one, there's a threat of Chinese companies being delisted in US stock exchanges. What do you think about this, and how would this impact the valuation of these companies in the mid to long term?
Yeah, so I mentioned that in the talk. Delisting is a risk. It is a midterm, I think, a serious risk, and I think it will have a downward pressure on the prices of Chinese stocks, at least in the next year. And if there's more delisting, it will probably get worse. And I don't know how many of them will be left to be directly tradable in 2 years, 3 years. But none of the things that we've seen have reduced those risks on both sides. Both countries have really put the squeeze on these companies.
Okay, thanks. And then another pre-submitted one. What's your perspective on the risk that China will at some point stop or severely limit the trading of Chinese equities on foreign exchanges?
Yeah, that is also a possibility. I think the Chinese policymakers need to spend a little bit of time thinking about what that cost would be, the cost, because China has many startups right now that are still private. There are almost 200 unicorns right now, which are private companies in China with $1 billion or more US valuation estimate based on their private funding. And those companies, most of them probably want to go public. So where would they go? Do they really want to go back to China? And could the Chinese capital providers absorb that much new public capital? Historically, those companies have actually come over to the US or listed in Hong Kong. I don't know what that would do to their private equity and venture capital markets if they could not list could not access foreign capital.
Okay. Well, I see we're at time. I know you've offered to stick around with some more questions if they keep coming, which they seem to keep coming, but I'd like to formally conclude just so that people can head off. So thank you again, Dr. Charles Lee, for joining us today and for sharing your insights. As we've seen in the chat, people are thrilled with your presentation, and it's just been a terrific discussion. We hope you enjoyed today's Knowledge Lab webinar. Please continue to check the DeGroote website for upcoming webinars and activities as we post our activity for 2022. Thank you, everyone, and happy holidays. Okay, so we can continue with a few more questions then. I think we've already answered Peter's question. The next one, are foreign companies operating in China subject to controlled interest groups?
Are foreign companies in China subject to controlled interest groups? I'm not sure what is meant by controlled interest groups. Everybody has to play by the home court rules. Tesla has to work things out, just as McDonald's has to work things out, and Yum, that is the KFC and so forth. They all have to work things out. Oh, you mean the controlling blockholder problem? No, those foreign companies are really not subject to the controlling blockholder problem. Yeah, those are the controlling blockholder problem is actually symptomatic of Chinese companies that are headquartered in China.
Okay. From Mike, what about Taiwan? Is the conflict between China and Taiwan going to escalate?
Oh, I hope not. Having been born in Taiwan, I hope not. It would be very bad for everyone. Well, maybe not everyone, I guess, but enough people that I care about. I hope not, but I don't know. Yeah, it's something I try not to think about because it's such big implications. But right now, China are short a lot of things that Taiwan has, and including semiconductor companies and an entire ecosystem of. And China has never relinquished ownership of Taiwan. So, and the ability of Americas to serve as a deterrent for this is probably not as strong as it used to be. So.
Okay. From Edward, how do American and Canadian companies function in China? For example, if I invested in Coca-Cola or McDonald's, how likely are they to grab Chinese customers and thus invest via America to get to Chinese consumers, I should say?
Yeah, so the history of global conglomerates and American companies and Canadian companies operating successfully in China is checkered. So some companies have had to pull out, and for a variety of reasons, but other companies have thrived. McDonald's has done well, KFC has done well, certain American automakers have done well, and Caterpillar, for example, is now most of the business is from China. But there are many others who have had. Google, for one, has pulled out because of they didn't comply with some of the requirements, and others. So yeah, it really is case by case.
Okay, here's a longer question. Will the CCP be indiscriminate in pushing ADR delisting of Chinese-owned operated enterprises, or will they be more selective? Some of those companies benefit from having access to foreign capital and investors. What do they believe this delisting accomplishes? Is it motivated by protectionism?
Yes, so historically, they have allowed this because their most enterprising and entrepreneurial companies didn't want to list anyway in China. There were many problems with the IPO process in China that is very political and arduous. And so for example, they required people to be profitable before they were listed. One year we did a calculation of all the Chinese companies that listed, of all the companies that IPO'd in US, 76% of them would not qualify to list in China because they were so demanding in terms of how much profits these companies are making. And we all know some of the most enterprising IPOs in recent years have been not profitable, at least at the time they went public. So some of the most enterprising Chinese companies have gone overseas to get their money. What happens to the Chinese innovation process because of this, I don't know. I'm hoping that the Chinese government thinks about that because sometimes it doesn't hurt right away. The hurt is deeper and longer. And I'm also hoping that there will be still a lot of financial exchange because it leads to stability. when everybody is feeling that they need to be self-sufficient, and there's a lot, economically speaking, we spend a lot of time wasting our resources. A global economy is just, economically speaking, much more likely to lead to prosperity.
Okay. Another question about US listed Chinese companies becoming delisted next year. You said there's a chance shareholders could get an equivalent of HK listed shares. Is this broker specific? Say, if I have US listed shares through a Canadian bank that doesn't directly invest in Hong Kong Stock Exchange, what would happen?
Well, they will say, well, you have claim to this stuff. Why don't you go and open an exchange, a brokerage account where we can deposit your shares? So, yeah, they will say, well, we've offered it to you. If you are not going to do that, then that's your problem. This is my best guess. I don't know what will happen. Yeah, and you can see there are a lot of investors who aren't willing to move exchanges. There are some institutional investors, pension funds and others here who don't, who have restrictions. So in terms of holding shares in international exchanges. So I think that is a problem, and it's already happened with DD. As I mentioned, there's pressure from both countries to force change on these companies. They're really getting squeezed on both sides.
Okay, so the questions keep coming. I'm going to suggest we cut them off, and so we've taken a lot of Dr. Lee's time already. Maybe we could just do a couple more and then wrap up. So when considering the murky stance of VIEs, especially those of tech firms, what impact do you see on their status and attractiveness with the increased pressure from the CCP to have state ownerships, have a state ownership stake, bearing in mind the test case of Baba handing the state an ownership stake in Ant to continue operations in China?
Yeah, that's just the way it works. You know, when your partner in the joint venture is also the court and the referee, it's hard for you to get a fair slice. I mean, when things change, things are likely to change in the direction that is in favor of your partner. So this is a lesson that everyone is learning, including you know, entrepreneurs in China. So yeah, I guess you can only say that if they take too big a bite, then it will hurt other things that are important to stability in China. So that's the only thing that we can sort of hope to appeal to. Stability is probably uppermost in mind when it comes to the Chinese, you know, governed policymakers, and stability depends on things like people having jobs. so at some point, I think that has to kick in.
Right. Okay, and our last question. Thanks for the presentation, Dr. Lee. This is coming from someone who's always been interested in Chinese equities, but hasn't jumped in because of the risks associated with them. I think it's a good wrap-up question. Do you have any risk adjustment method recommendations you think could be useful?
Oh golly, I mean, I'll be honest. I'm frankly very worried about jumping in at this point, even though it looks cheap. Very hard for me to know what discount rate I would use for a company where property rights are not clear. I don't know what I will own going forward, and I also know that as a foreign investor in a Chinese company, I'm just not important. so I'm hoping that some of these people, Ray Dalio and others, will be more important to the Chinese government than I am. But right now, I don't feel like I'm sufficiently important to bear that risk.
Okay, some good cautionary notes there to end on. Thank you again, Dr. Lee, for joining us and sharing your insights. Thanks to everyone for the great questions. It's been a fantastic amount of enthusiasm for this topic and great questions. And again, to wrap up, we hope you enjoyed the webinar today. Please check our website for upcoming webinars and activities for 2022. And thanks again, everyone. Great holidays to you all.
Take care. Happy holidays.